Good afternoon. Welcome, everyone. Thank you for joining us for today's webinar. My name is Lisa McGinty, and I'm the Chief Marketing Officer at FreightWaves. We're excited to be kicking off the first of our monthly market update webinar series today. Appreciate all of you joining us. This new series is designed to provide data-driven insights, commentary, and analysis around current freight market activity. In addition, we'll be sharing forward-looking market outlook insights. We will be leaving time for a 15 to 20-minute Q&A participation with the audience at the end of the presentation. We will also be sharing a recording of the webinar and the slides presented today via a link after the webinar. Today's title is this the end or just the beginning? What the data is telling us about the freight market. Presenters today are Craig Fuller, CEO and Managing Director of FreightWaves and the Managing Director of the Blockchain and Transport Alliance, and Ibrahim Bayan, FreightWaves Chief Economist. Before we get started, just a few housekeeping items. If any of you have questions for the presenters during the presentation, please type them into the Q&A box at the bottom of your Zoom webinar control panel. The team will monitor both Q&A and chat questions to answer questions quickly throughout the presentation. However, we'll also leave room to address questions at the end of the presentation directly with Craig and with Ibrahim. Without further ado, we'll turn this over to Craig and let him continue.
So today's agenda, we're going to dive into the current market situation on the freight markets, the fundamentals for growth, the tariffs and the risks to the outlook, trucking capacity and trends in employment, and we'll end with a discussion around oil prices and the impact to the freight markets. I'm here today, this is Craig, and I'm here with Ibrahim. Good afternoon, everybody. So Ibrahim is our Chief Economist here at FreightWaves, has been around the transportation business for nearly a decade, and is a PhD economist. So he will be diving into the economic fundamentals of the freight market, and I'll dive into more of the data-driven elements of capacity. So real quick, for those that have not heard a little bit about FreightWaves, we'll spend 2 seconds on it. Effectively, what we're doing is creating a community in freight that uses data and technology to help companies understand, react, project changes, and ultimately de-risk the market. Our team is made up of 10 reporters, journalists, of which we have 5 PhDs on staff, 2 full-time economists, and we get about 1.3 million page views a month. I think it's really reflective of the fact that we combine data and tribal knowledge to understand what's happening. And I think that's really a huge differentiation factor, is that not only do we have data to back up our assumptions, but our team has been in the physical market and has dispatched loads and handled transactions, so they understand the tribal elements of what it takes to be in the freight market. So I'm going to turn it over to Ibrahim real quickly to go through the economics.
Good afternoon, everybody. This is Ibrahim Bayan. Like Craig said, I'm the Chief Economist here. I'm going to cover some of just the macroeconomic trends that are guiding freight market conditions. I wanted to start just by looking at overall growth in the economy, just to give you an idea of where we are in the U.S. economy right now. So up here, you have U.S. gross domestic product, which is a measure of all the output that gets generated in the U.S. economy every quarter. The blue bars here is the quarter-over-quarter growth. And you can see the quarter-over-quarter growth is a bit choppy, but it's been strong over the last year or so. You can see at the far right, we have our projections for GDP growth for the second quarter. That doesn't get released until the end of this month. But we're thinking it's going to come in slightly above 4% growth for the quarter. That's very strong by historical standards, very strong by recent history, certainly. And I think it helps just give an idea of just how strong things overall have been in the economy during these past 3 months. The black line here is year-over-year growth. You know, I typically refer to year-over-year growth to try and give an idea of what the general trend growth is, sort of how general trends are improving over time, because the quarter-over-quarter numbers can be so choppy. You can see just a gradual improvement in economic conditions over the past several quarters, like really since the start of 2016. The economy has been gaining momentum fairly steadily, and I think it's going to continue into the second quarter. The second half of the year will also be very strong growth in the economy overall. The unique thing about what's going on over the past 3 months is that it feels like every aspect of economic activity is pointing in a positive direction. Normally, when you look at like individual quarters in the performance that go in the U.S. economy, things expand overall, but there are weak areas and strong areas. But the second quarter has been pretty unique in that almost everything has been pointing in the right direction. You've had stronger consumer spending this quarter relative to the first quarter. Business investment is still very strong in the economy. Housing has been a little bit of a disappointment, but it's been improving gradually. Inventories are also rising, and the trade deficit is also declining. And so, the combination of all these things is what leads you to that over 4% growth that we expect to see when the GDP numbers are released for the second quarter. Right now the economy has a number of things sort of helping it. We're still kind of feeling some of the benefits from the tax cuts that were enacted earlier this year. There were some sort of one-off benefits to trade that helped activity in the second quarter, and it's kind of pushing businesses to capacity and forcing them to spend money to invest in new facilities and things of that nature. So all of this just to say that the economy seems to be on really solid footing in the second quarter, and I think when you look forward, it should continue to be strong in the second half of this year. So just to take a look quickly at some of the major sectors of the economy that help drive freight demand. This chart here just shows industrial production in the economy. And you can see that there was a sort of a 2-year period here, beginning in the middle of 2015 through 2016, where industrial production just did very poorly in the economy. And this coincides with weakness in freight markets. But really, since over the last year and a half or so, industrial activity has been improving fairly steadily. And the first half of this year has been particularly strong, with growth averaging over 3% year over year in the industrial sector. Now, part of this is just because of resurgence in oil prices and mining and drilling for oil. That's helped boost the industrial production numbers. But even core manufacturing, once you strip that out, is showing some signs of improvement. And I think as long as you have this environment where there's healthy business demand, healthy consumer demand, and export demand is also very strong, all of that leads to strong manufacturing demand, and in turn, strong demand for freight. A quick look at labor markets. One of the interesting thing about, the thing to note about labor markets is that underpins a lot of activity in the U.S. economy. So one of the reasons why consumer spending is so strong is because the labor market trends have been so strong. That means that hiring is taking place at a very rapid pace. Over 200,000 jobs added each month over the last 3 months. And so that's good news for U.S. consumers because it gives them income support to go out and buy more things. The unemployment rate in the economy is near historic lows. It's at 4.0% now in the economy. It's up a little bit in June relative to what it was in the previous month. But when you look from a historical perspective, like a normal functioning economy has an unemployment rate of about 4.5%. And so we're well below that in the economy right now. And we've been that way for quite a while. You're starting to see workers that had been on the sidelines of the economy starting to rejoin the labor force. There's plenty of job openings. In fact, record opening. We just came off of record job openings in the economy overall. Very strong hiring in the economy. But there are some challenges that come along with this very, very low unemployment rate. Like when you have unemployment that's as low as it is, below what you would consider normal for a functioning economy, what it means is that it's very hard to find labor everywhere. And so any sector that's experiencing like significant growth is having a hard time finding workers to fill available positions. And this is the case in freight markets, of course, but it's also the case in several other areas of the economy. Manufacturers are reporting difficulty finding laborers. Construction industry is reporting labor shortages. And I think as things go on, this is going to become more of a trend. Like as long as you have strong growth and companies that are willing to hire in a low unemployment rate, it's going to be very difficult to find workers to fill available positions. On the retail side, I mentioned earlier that there was a real rebound in consumer spending in the second quarter of this year. And I think this chart kind of shows that this is total retail sales and the year-over-year growth. You can see that the holiday season last year was particularly strong. Like there was very rapid retail sales growth in October, November, December of last year. In fact, I think it reached over 6% by November of last year. And then once you got to the other end of the holiday season, there was a bit of a drop-off. like a little bit of a spending hangover that took place in January and February of this year, and it brought down the first quarter numbers in terms of overall economic activity. But you can see it was just a very strong numbers throughout the course of the second quarter. Like April, May, June results came in, and they were all very positive in the economy overall. Another thing to note about retail is that e-commerce is continuing to gain a lot of share. E-commerce has been one of the fairly constant growth areas in the U.S. economy for several years now. Even in the first quarter, when there was a spending hangover overall, it really wasn't the case for e-commerce. And all of this e-commerce puts additional pressure on transportation markets in general, because it's just an additional leg of transportation that has to take place for these goods. Rising retail spending leads to inventory turnover. So as long as sales are strong, it means that companies are going to have to replenish their inventories frequently. This also helps drive freight demand in the economy. So on the inventory side, when you look at inventory sales ratios, they've been coming down also throughout the early part of this year. Inventories themselves are rising. So, I mean, companies are building up their inventories as the year is kind of going on, but sales are rising at the same time, and the relationship between the two has actually been falling. And so what this is telling you is that the inventories that companies are keeping on hand, they're still very lean, and they're getting leaner. Now, whenever you have this kind of lean inventory in a very high demand environment, so I said, growth was very good in the second quarter, but inventories are getting leaner. All this means is that inventories are turning over faster and faster. Okay, and this puts a lot of pressure on transportation companies, on carriers to try and meet delivery deadlines. That companies are trying to manage their inventory spend by keeping their inventories fairly lean, and as a result, it just means that you have to be ready to fill up inventories when they get depleted because of the strong sales. So just an additional source of pressure on freight markets. And I think the combination of just strong demand, strong manufacturing demand, strong retail demand, and lean inventories is creating just a high demand environment for shipping in the U.S. economy. And I think it's really reflected in the freight data.
So it's interesting, you mentioned inventory build, and one of the questions that we get asked quite a bit is, does the effect of Amazon or e-commerce actually increase or decrease the amount of freight flow? And it's obvious by looking at that inventory chart that it actually will increase the amount of freight in the system versus detract it. And so there is higher demand for freight. One of the things that we also get asked quite a bit is the freight markets, is the situation in the freight markets really a reflection of a lack of capacity due to things like ELDs and labor, or is there actual organic growth of freight demand in the market? One of the indices that we look at reflects on freight bills issued by Cass. Cass is one of the freight payment companies, and they have something called the freight index, the shipment index. If you look actually at typically we have every January, no shock to anybody that's been in the market, the freight market softens in January. We didn't see that trend actually take place this year. First quarter was unusually strong. It went from about 114 to 131. So if you take that, if you look at it, it's about a 15% increase in demand related to shipment volume. So not only do we have tightness in capacity related to things like ELDs and employment, we also have high demand related to just a lot of freight in the system that's unusual for that time of year. The other thing that's interesting is we think about what's happening with ELDs and how carriers are reacting to the impact to ELDs, particularly now they're starting to value their time to a degree that they didn't before. The capacity constraint is less about how many miles a load is going to actually how much time it takes. And we can actually see that in the ELD data. So we have two indices. One is related to the local tender reject index, which is the willingness of carriers to take loads that have less than 100-mile length of haul, and the tweener tender rejection index, which is a reflection of willingness of carriers to take loads that are from 450 to 800 miles. On the local side, the rejection index had gotten as low as 6%, so only 6 out of 100 loads were being rejected by carriers in April. That did peak at the end of May to about 12% or 11.5%, and now is averaging about 8.5%. So that means only about 8.5 out of 100 loads is being rejected by carriers, which means there's really not a lack of capacity in that local tender reject index. But what is interesting when you go back and look at the tweener, which we define again as 450 to 800 miles, is that the rejections are as high as 34%. So they've gotten as low as 27, have not been below 27%, and have shot up to about 36%, which if you think about what a tweener means, it means that drivers in the old days before the ELD mandate could actually take a load past what they were actually allocated from an hours of service basis and haul loads in a market that weren't legitimately hauled under the hours of service regs. Now that those hours of service regs have been implemented and mandated, it means that drivers are much more sensitive about what kind of freight they take. And because of that, it means that carriers are thinking differently about which capacity to actually accept, and they're rejecting a lot more loads because of it. So we're seeing a much tighter percent of capacity rejections in the tweener markets. I would expect pricing related to the tweener markets to actually shoot up over the next year versus fall down, and see very little pricing pressure in that local or short haul market. I think most of the pricing pressure will be in that mid-sized market. You can actually see this show up in the spot correlation. This is an analysis done on tender rejections out of Dallas and look at how it, using DAT spot rates and looking at how it actually moves the spot rates. Where you see high rejections on tender rejections, you will also see that show up in the pricing data, and we can see that here. So the Dallas spot rate increased 8% in May, then another 13% in June, while rejections moved from 17 to 25%. So really high volume. What you see at the tail end of that in July is just a reflection of the fact that we're past a major holiday, and therefore the market's starting to settle in again. But we've been looking at data today that suggests that the markets will strengthen through the rest of the month. One of the other things that we had been talking a lot about or are curious about is how do drivers think about their hours of service? How are they thinking about how they manage their hours of service? And so we actually look at hours of service daily driving utilization. So drivers are allocated 11 hours to drive. We know by looking at historical patterns that they aren't using all 11 hours for driving purposes. In fact, if you go back and look at, the you had the soft mandate on December 16th. You had this really the hard mandate on April 1st. What's interesting is if you look at the hours of service data, and you can see this in this chart, that the top end of the market was about 6.8 hours per day that they were driving. That's not the average. The average is about 6.5. But prior to the hard mandate, drivers were not really moving above 6.8 hours of driving or time dedicated to driving. As we moved into the April 1st hard mandate, you can actually see that drivers were starting to maximize the hours toward driving, or maximize much more than they had in the past. And we moved up about half an hour a day of driving, dedicated driving. What that did is two things. One is it meant that drivers were being more selective of what freight they picked. It also meant that they were managing their hours perhaps more efficiently than they were before. They were picking to do business with customers that were more friendly to their hours and were more efficient. That reflected in that tweener index and rejection that you saw. It's also reflected in freight selection. What also this means is that there was additional capacity added to the industry related to the total amount of capacity. We see it actually increase. If you figure that drivers are getting another half hour a day, they're actually adding about 4% more capacity related to the market overall. So that is meant, what that means is the market is operating a bit more efficiently than it was before. Drivers are still not maximizing the 11 hours, and they are unlikely to do so, but we do see them thinking differently about how they pick freight.
So just the combination of all these things, you know, the market conditions that we mentioned earlier and some of the issues that Craig was talking about earlier has really just led to an overall very positive environment for freight rate pricing in the U.S. economy. So here I have producer price index data. This is macroeconomic industry level data that the government collects on just the rates that various modes of trucking are charging. And you can see the blue line here is long distance truckload. The black line here is the LTL market for long distance. And in both cases, you're looking at just very rapid price increases year over year. For long distance, I mean, you're talking about almost 9%, long distance truckload, almost 9% rate increases year over year. And that's the fastest pace of growth in price inflation in these markets in several years. And I mean, in the truckload market, when you're talking about since in over a decade, and in the LTL market, you're looking at over the strongest pace of inflation over the past 5 years. Now, what this does is it's kind of making all of these shippers in the economy begin to reevaluate things. So if you're noticing high rates of price inflation in trucking, what we've found is that shippers are beginning to investigate whether or not they can begin to move some of that freight through some other mode of transportation. So you start hearing reports about taking some of the things that might go via truck and trying to move it via intermodal, and spilling over into different kinds of modes of transport. I mean, intermodal basically is seen as like the slower, cheaper version of freight. And when trucking gets too expensive, maybe it's worth it to sacrifice a little bit of time in order to save on the cost side. Now, what this does is it just starts to increase the demand for intermodal services in the economy as well. And so you kind of have this spillover effect of just high demand for trucking services spilling over into intermodal, and that's making prices in intermodal also increase very rapidly. I mean, in the last report, I think intermodal rates were up over 15% year over year. And all of this, I think, is just being driven by the fact that there's just a lot of freight in the economy overall. And these shippers, they're just trying to figure out what the cheapest way is to do it and get things from point A to point B in a reasonable amount of time. And I think, as time goes on, if the economy holds up, which it looks like it's going to, you would expect these kind of spillovers to begin to continue. And you'll start to see more and more businesses begin to reevaluate just how their supply chain looks and how they move things from point A to point B. Now, one of the areas that I left out earlier intentionally in terms of like areas of strength in the economy has just been the performance of trade. So here I have goods exports and goods imports for the U.S. economy. And in both cases, trade growth has been very strong over the past year or so and gaining some momentum. And so you can see, like on the export side, over 10% growth year over year in goods exports in the economy. Imports have died down a little bit, but you're still talking about 8 to 9% growth year over year. And this is good news for transportation companies. Again, I mean, this is another source of just high demand in the economy overall. It's good for drayage services as you get things to and from ports. It's also good for like like logistic companies that have to figure out how to get things all across the world. And so this rapid pace of growth in international trade is just helping freight demand overall even further. But it's also one of the big risk areas in the U.S. economy. It's hard to talk about anything related to the outlook for the performance of the economy without digging into what's been going on with trade policy. And so I included here a brief timeline of tariffs. This is just what's happened this year. And believe me, this timeline could be quite a bit longer if I decided to include all the different pump fakes and negotiating ploys that have been used along the way. But really starting in January, when there were some tariffs imposed on washing machines and solar panels coming in from the rest of the world that causes prices for these things to shoot up. The U.S. has been on an increasingly protectionist kind of path. The big moves on the international trade policy front were the tariffs on steel and aluminum imports, which were announced in February. They were put into place in March. And then sort of the back and forth that the U.S. and China has been going through with tariffs and retaliatory tariffs on goods from both of these countries. Now, when you look at these tariffs and sort of what the impact's going to be on overall economic activity, the size of these tariffs and the amount of goods that that they're being placed on, it's not large enough on its face to really disrupt economic activity all that much. I mean, even some of the most recent threats where you're talking about like 100 billion, tariffs on $100 billion worth of imports from China, it will affect certain industries, certainly. But in terms of like overall macroeconomic impact, I think just by themselves, it's not enough to really derail anything. But you do worry about sort of how these tariffs spill over into the rest of the economy. Consider that a lot of what drives growth in the economy right now is just the fact that consumers are feeling pretty optimistic, businesses are feeling pretty optimistic about the future growth in the economy. And if you start to take moves, make moves that will begin to dent this kind of confidence, you worry that might drag down overall economic activity. It's also created quite a bit of uncertainty. Like when you read survey data about the U.S. economy, one of the biggest things that comes up is just how there's this cloud of uncertainty around what trade policy is going to be, especially with people that are in some of these targeted industries. If you look at like steel manufacturers, or aluminum, people that use aluminum as part of their production process, all they can talk about is how just the lack of clarity on what tariff policy is going to be is disrupting just their natural business functioning. And going forward, if things escalate significantly, there are potentially much bigger macroeconomic implications. The U.S. has kind of put a lot of feelers out there about potential tariffs that they want to enact, and if everything kind of goes through, it's definitely significant enough to take us out of this like high growth environment that we're in right now. But I'm still kind of in this camp of wondering how much of it is going to turn into actual policy and how much of it is just sort of negotiating ploys on things. What you will find is that businesses are going to begin to kind of hedge their bets around tariffs, especially now that some of these tariffs against China have been enacted. You may see companies begin building up their inventories a bit more now, so that they can kind of be prepared in case tariffs, additional tariffs go into place. But in terms of overall macroeconomic impact, as long as the tariffs stay like kind of where they are now, within some kind of reasonable range, and there's not a significant escalation, I think the overall macro impact is probably pretty small.
So one of the things that we've been looking at, and we can see this in the data, that container prices out of China can actually lead U.S. trucking demand, particularly off the West Coast and specifically out of LA. So we saw that. You can see that in the chart that I'm showing. This is a reflection of container prices on a 40-foot container off the coast of China into the North America West. You see the Chinese New Year start, and you saw some declining rates and related to outbound containers out of China into the West Coast. And that leads trucking prices by about 6 weeks. 4 to 6 weeks, you can actually see, as you see container prices shoot up, you can see much higher trucking volumes and much higher spot prices come off the West Coast about 4 to 6 weeks after you see the surge in container prices. One of the things we looked at actually this past weekend was the drop related to outbound Chinese containers into the North American West that took place this past week. We thought it may be more terminal, maybe more concerning as a reflection of slower trade. But this week we saw a very violent move up, which is suggesting that shippers just don't care. They're going to move freight regardless of what it costs. Consumers are going to still continue to buy goods. And as long as that demand doesn't dry up, we'll still see it. So having said all that, there's a substantial amount of volatility on the high seas. We also expect that in about 4 to 6 weeks that you should see high demand of trucking services move into the peak season starting in late August and early September. And it looks very bullish for the late third and fourth quarters going into the peak shipping season. So no reason to be concerned. I was softly concerned, or at least observant of this index last week. But look at what we're seeing today is suggesting that it has had zero impact to how shippers are thinking about their business and on the demand side.
So just to shift gears a little bit and talk a bit about capacity and how it's developing in the trucking industry. One of the things that we typically keep an eye on is just the rate of hiring of new drivers in the economy. That it's one thing to look at, say, truck purchases and things of that nature, but really what's going to drive the amount of freight capacity that's going on is the number of new hires, or the net number of new hires that join the industry in the trucking industry. And so here we have truck transportation employment in the economy, and it's actually done fairly well in recent months. That I mean, you can see here there was a period of time, 2015, 2016, where the amount of employment in trucking was fairly flat. But really at the end of last year, the beginning parts of this year, trucking employment has been gradually improving to the point where now the rate of hiring in trucking is a little bit faster than the rate of hiring overall in the total economy. So that means that trucking is gaining a little bit of share in employment these days. Now that's good. It's a sign that kind of the industry is responding to all of this high demand that's out there and taking the steps that's necessary to attract new drivers. But I don't think it's good enough. Like when you look at the rate of growth in the economy, especially on the good side of the economy, like there's so many positives that are driving freight demand high, that this idea of growing, say, 2% year over year employment, I don't think that's enough to kind of resolve the capacity crunch that's facing the trucking industry.
One of the things that we also look at is sectors as to which are having, think about retail and think about warehousing, e-commerce. There's not a secret that those industries are on fire. What does end up showing up in the data is really two functional things. One is you can see higher demand for shipping, but you also see companies like Amazon and companies related to e-commerce shipping adding warehouses. They're adding fulfillment centers. They're increasing those exponentially, it seems. Warehouse employment since 2000, actually since the Great Recession, is up 52%. In the same time, trucking employment is up about 10%, and retail employment is only up 7%. So we have not lost retail jobs per se since the Great Recession. We're just not gaining them at the same pace of other industries. Warehousing is on fire. We've discussed a lot about warehousing employment. Does it actually hurt the trucking picture? There's a lot of schools of thought here. We think marginally that could be happening, but warehousing pay rates are not yet at a level that somebody would choose a warehousing job over a trucking job, but that could happen over the next couple of years, and we'll see how that happens. It looks as if, though, trucking pay rates are going up double digits and are probably responding in kind, and therefore warehousing pay rates will follow because they don't have the lifestyle factors and other elements that are considered. One of the other things Ibrahim touched on, really used truck pricing, or mentioned used truck pricing. Employment is certainly the most reliable indicator to capacity, but what is not accounted for are independent owner-operators that own their own businesses in those BLS stats. And so one of the things that we like to understand is the OEMs are having record years. 41,000 trucks on average for the past 9 months is what they've been producing, which is as much as in some months is a 25 to 30% increase in production. They're sold out 8 to 10 months now in terms of new truck orders. So one of the things we're watching is, are independent operators and small fleets, private companies buying used trucks? And so we look at the 3, 4, and 5-year cycles to understand that. You're starting to see a little bit of firming in capacity, firming in used truck prices. Go from the high 50s, about $56,000 for a used truck, to about $60,000 for a 3-year a truck that was 3 years old. That, to put that in perspective, that's still below the 2015 numbers. So we're not seeing a mass a bunch of independents just go out and buy a bunch of trucks. They are adding trucks, albeit at levels that does not actually increase the net capacity. It may increase the net capacity, but doesn't actually resolve all of the demand that's out there. So nothing to be worried about in terms of either used truck growth or enterprise fleet growth at this stage, and no reason to be overly concerned about what's happening. But this is an index, along with the employment index, that we should watch going forward. What I would be concerned about is used truck prices is actually a leading indicator of overall demand of trucking services. And so if that starts to falter, then I would start to look at some of the other data to see if that reinforces the view that the market may be slowing down. We can talk on oil. It is certainly driving, when I was younger, my father used to talk about when oil prices go up, that is a bad thing for the U.S. economy because we consumed oil. We're now one of the largest producers of oil. In fact, I saw something that Texas is now the #3 oil exporter in the world. So it's an important part of our economy, and every oil rig that's created in the U.S. Actually adds 1.1 million truckload miles. So oil and the oil markets is actually driving a lot of economic activity in parts of the country. And because of that, as oil goes up to a point, I think when it gets to a point where it's unsustainable for the broader economy, but as oil goes up incrementally, it actually increases demand for trucking services. So we're seeing diesel prices are also increasing along with oil prices. That will continue to reflect and impact carriers on the cost side. The good news for enterprise carriers, less so for owner-operators, is that those costs are passed on through fuel surcharges, which means that really carriers are actually recover a lot of those costs because their shippers are picking up the bill. That does mean, counter to that it increases, and you'll talk about this in a second, the producer price index related to trucking services, because as oil goes up, so do the cost of shipping services. One of the things that also reflected on the demand side of it that the oil markets had is you can go look at places like Houston. Houston is, as a major market, has one of the highest exposures to the oil markets of any U.S. market. And so you can see that tender rejections have really stayed consistently throughout the first part of the year up until about May. We have other markets we look at where you saw some bigger moves down, some more volatility on the lower side of the market. Houston stayed pretty strong through the first part of the year. Some of that's hurricane rebuilding, but it's also related to the oil markets we think drives the Houston market. And we've seen over the last month and a half to 2 months really strengthening for the broader market, but certainly Houston can't be left out. Dallas as well also has a lot of exposure to the oil markets, and they seem to move in tandem. One thing I will focus on is the current state of the freight market. The real strong parts of the freight market is along that Missouri Valley and Southeast. We think it's a sign that the manufacturer economy is strengthening. It's a sign that the oil markets are strengthening. Ag seems to be really strong. Seeing the eastern half of the country really reflect really strong freight conditions, as that should also then show up in pricing as carriers think about how they price freight. This particular map is an indicator of tender rejections, which is how much, whether carriers are willing to honor the loads that they're being tendered or whether they're rejecting them. On the eastern half of the country, really east of I-35, there's a significant amount of rejections happening versus the West Coast, which is really a reflection of the broader part of the economy versus imports. It's really a reflection of the manufacturing and other commodities that are on the eastern side of the country.
So just to wrap up with a couple of comments on the outlook for the rest of this year, I mentioned in the beginning that the economy right now is kind of firing on all cylinders headed into the third quarter. The second quarter number is probably going to be the highest GDP growth that we're going to get for the rest of this year. Like I expect, the third quarter will still be strong, but not quite as strong as say the 4.2% growth that we expect for the second quarter. But all the fundamentals, all the underlying fundamentals say that growth should be strong, throughout the rest of this year. And you really, not until you get to 2019 and you start to wrap some of the tax cuts that were put into place this year, do you worry about any kind of significant slowdown in overall economic activity. 2018 looks like it's going to be a very good year relative to recent history in terms of just economic activity. And that's going to keep trucking capacity pretty tight for the rest of this year. Like, I mentioned earlier when we were talking about employment, that trucking capacity seems to be expanding because more drivers are hiring, but it's not enough hiring to resolve the capacity crunch and kind of ease some of the stress on overall freight demand. And so I would imagine that, for the rest of this year, we're going to be in this kind of very tight capacity environment for the U.S. economy. Now, the caveat to all of that is that there's still trade policy out there. Like I mentioned earlier, that as long as the trade policy stays around where it is now with some of these tariffs, and you don't see like a significant escalation, then the economy is strong enough to kind of withstand that kind of blow. I mean, the U.S. economy has been pretty resilient since the recession ended. Like we've dealt with a lot of different shocks to the system, and so a couple tariffs here and there aren't going to throw us into a recession. A full-blown global trade war, however, if something like that happens, then you kind of have to revisit what you think about things, particularly on the transportation side. That if you start to see us getting involved with tariff disputes with some of our allies like Canada and the EU on a broad scale, or just worsening with the situation with China significantly, then we'll kind of revisit and talk about what to expect then. But as long as things kind of stay the way they are, everything points towards pretty strong growth throughout the rest of this year and a continued tight trucking environment.
One of the things that I would say, if you could take away from this particular conversation, is that the market is not softening. We don't believe we're at the end of the cycle. It looks really strong for at least the next couple of months, and probably through the rest of the year. No reason to be concerned. It looks like the cycle will continue. Trucking capacity continues to be tight, even after the holiday. Rejections have stayed pretty significant relative to what they were a year and a half ago. And if there's any kind of shock to the system, a black swan event like we had with the hurricanes last year, that would send spot rates through the roof. One thing I would say is, we're not expecting a ton of spot market volatility, at least for the next 30 days. I think spot rates will stay high. Contract rates will continue to stay high. Shippers are thinking more strategically about their planning. Ibrahim mentioned intermodal. As long as there are those outlets for capacity, shippers will have choices, but will be paying much higher prices. If we have an event like we had big hurricane last year, back-to-back hurricanes, that could send shockwaves through the spot market, and you would see high inflation. But as of right now, the spot market should create a little bit of inflation, but you won't see this massive volatility and shock that you saw late last year.
Great. Thanks to Craig and Ibrahim both for their insights and for the data that was presented here. We're going to jump into a Q&A here in just a moment. We've already received a handful of some really good questions. For those of you on the phone, you can look for the Q&A screen within your Zoom webinar to the bottom right. Click on that and ask your question. We'll get to them in just a moment. Before we get to that, just a quick wrap up on our next steps. Again, this is a monthly market update webinar, so we will be doing this every month with a little bit of a different spin on the economic outlook and the drivers behind it, and it will vary as market varies. So you'll see an announcement on that soon relative to our August date and title and speaker that will be involved. All the screens presented today were directly out of our FreightWaves Sonar market dashboard. As you can see, they have great data visibility and insights available through that tool. If you're interested in learning more about that, you may reach out to Michael Vincent at mvincent@freightwaves.com. Again, we'll be releasing this presentation via link, so this information will be accessible through that as well. And then lastly, for more great market and economic focused insights, we do offer this same sort of content at our MarketWaves 18 event in November in Grapevine, Texas on November 12th and 13th. If you aren't registered to attend that event yet, you probably need to get on it. Our last event sold out before the event started in May, and we're expecting that to happen again with MarketWaves. You can register for MarketWaves at freightwaves.com/MarketWaves18. Now on to our Q&A. I'll start first with a question from Patrick. Patrick's question is, truck driver openings have been plentiful for many years. Has there been an increase in the number of people attempting to get CDLs? And if no, any idea why people aren't seeking jobs that pay relatively well?
What is it? So to answer the first part of the question, so yes, I mean, you are starting to see like an increase in the number of people pursuing driver's licenses, but I just think it's slower than what's necessary. And as to why, I mean, it's kind of what I talked about at the beginning of the presentation when we were talking about unemployment. It's that labor is kind of scarce everywhere, and so there's a lot of truck driver openings, but there's a lot of openings everywhere in the economy, and so you kind of have to figure out how a driver's opening stacks up with other industries. Not only other industries, but just like other kinds of drivers. I mean, when you look at just trends within drivers, period, somebody that wants to be a driver has to decide whether or not they want to be a truck driver or, maybe like a parcel driver. With all the e-commerce that's around there, there's demand for both. Or they have to decide whether or not they want to go into manufacturing or construction or any other of the industries that are out there looking to hire workers, and because there's plenty right now in the economy.
Yeah, I think one of the things that is certainly not lost on many in the industry, but perhaps it's understated, is that trucking, particularly over the road, long haul, medium to long haul trucking, isn't the greatest quality of life. I mean, take the demographic elements to it, lifestyle elements to it. It is tough to get qualified drivers because it's not it's not a way that a lot of people want to make money. They're out away from home for 3 weeks out of a month. They're dealing with shippers that have inconsistent schedules. They have just a lot of lifestyle elements, just frustration that they have to deal with. And so because of that, and because those issues are real, it is not as desirable of a job as perhaps things they're competing with vis-a-vis construction, other types of jobs that may be there. You mentioned local delivery, competing with the UPS contract that's over $90 something cents a mile that's coming out. So over the road trucking has a lot of macro challenges that have to be solved if you're going to see an increase in driver employment. Having said that, one of the things that's also not when you talk about high pay, yes, it is true that drivers could make $53,000 to $55,000 a year. And while you look at the amount of driving hours, you look at what they're making on an hourly rate when they're actually driving, say it's $22 to $23 an hour. You look at the total amount of hours that they are sitting at docks, looking for parking, maintaining their truck, washing their truck, all the stuff that goes on, it actually starts to look less desirable than many other jobs that competes with. You're talking $11 to $12 an hour when you look at the net cost of it. You can see that we see the driving index, HOS 11, shows that drivers have been driving about 7 hours a day, yet they have allocated 11, so they're not driving the whole time. They only get paid when they drive. That means they're doing other things than just driving. They're allocated about 4 hours to other stuff. So while they may be making what looks like on paper a very high rate, when you look at the total amount of hours they put into the job, it isn't as attractive as other jobs might be. Warehouse employment, I talked to an executive at an e-commerce company. Warehousing companies are paying, e-commerce companies are paying as much as $15 an hour, and some warehousing operations are seeing in markets as high as $20 to $22 an hour. And so these are issues that the industry has to address. Driver pay has to come up if you're going to get to a point of replenishing the driver force.
Perfect. So next question from Jim. What impact will tariffs have on the second half of 2018 business inventories and e-commerce activity?
So I think I touched a little bit on what might happen to inventories as a result. Typically what happens when these kind of policy decisions are uncertain is that companies may start to build up their inventories just in case, right? So if you're worried that soon these goods that you're importing from China are going to have like a 25% tariff slapped on them, you may begin to just start building up inventory of that stuff now, just in case it happens, so that it kind of buys you some time to figure out where you're going to source from going forward. On the e-commerce side, I don't know. I mean, e-commerce is fun. Like e-commerce has been one of the steadiest things in the U.S. economy since the recession, and it only fell a little bit during the recession. So I mean, if I tell you there's going to be double-digit growth, I don't think that's going to change much because of tariffs or anything like that. I mean, e-commerce, from my point of view, is just like a channel to get it to the end consumer, not necessarily something that's going to be directly affected by tariffs.
Okay, perfect. Another question from Doug. I think this is for you, Ibrahim. Does the producer price freight rate index numbers include fuel surcharges?
Yes.
Yes.
Yeah, and so you'll see that's a double whammy. I mean, the carriers are getting replenished. You know, fuel drives demand, but carriers, particularly the enterprise carriers, are able to pass those costs on, and then the shippers end up eating it.
Yeah.
So tight capacity plus fuel means high price.
Okay, great. Question from Mark. How current was the information on rate increases in 2018? I've heard higher numbers in the last 2 months.
I'm assuming that's the producer price.
Yeah, I mean, it's a government study. You do see, I think of the tweener market, you know, greater than 20% rate increases would not be shocking and would be kind of norm. You see in some of those local delivery, you don't see the high inflationary double digits in those markets. But these are averages. Keep in mind that certain markets have certain conditions that are going to drive higher rates. On average, double-digit truckload price increases should be expected and will probably be greater than what the government is reporting in certain lanes. But keep in mind that the trucking index that Ibrahim referenced is government data where they're tracking the total cost of shipping costs. And so there's a lot of variables that go into that. But double-digit increases have happened and will. I think we'll see a continue of an inflationary environment going into the peak season.
Okay. Question next would be, that one went away. So let's move on down. Is the new hire driver count exceeding the number of drivers leaving the industry?
Yeah. So the job numbers that come out about trucking employment, like those are net jobs. So it's going to take in like all the new hires that come in, and it's going to subtract all the retirements and things like that, or layoffs or whatever kinds of things that you might have. And so, you know, when you say that it's gained, say 25,000 over the last couple quarters, that's net jobs added. So taking into account.
It also doesn't reflect the independent operators. We do know by looking at just the fact that just truck prices are coming up, 15-20%. Over the last 6 months, that independent operators are buying trucks. They're not counted in those BLS numbers. They are buying trucks and adding some net increase in capacity. But I think we pointed out that shipment volumes far outweigh the current amount of incremental capacity adds. Therefore, no reason to be concerned that the market's going to fall apart.
Great. Next question, what suggestions do you have for shippers for best securing capacity? Transition of modes, dedicated services, private fleets, or all of the above?
Right. Well, I think you have to look at everything that you have in terms of resources available to you. This is not well publicized, but something from our sources have suggested that the railroads are going to be at peak really early in the cycle, and they don't have a lot of net capacity. Because what's happened is it's moved from truck into intermodal, and it's putting strain, especially as commodities move up. The rails only have a certain amount of capacity available to them. So intermodal is certainly an option, but I wouldn't make it my only option. I think you've got to think about your own way that you manage your operations. I think about you have to look at the efficiency of your docks and how fast you get trucks in there. If you run efficient operations, if you get drivers in and out within 30 minutes or within 45 minutes, and you have an attractive a dock situation for drivers to come bump your dock, I think you should broadcast that. I think you should be transparent. If you do not have an attractive operation and you're holding drivers more than 2 hours for loading or unloading, I think you're going to find significant capacity shortages, and I think it's going to be more difficult for you to find trucks. One of the things that we know that's happening, we have a lot of data and just knowledge that this is taking place, is that shippers, even if they're paying attention, if they run really inefficient docks and they keep drivers for a long time, they're having problems getting capacity at any price. And so one thing that if I were a shipper, what I would be looking at is my dock operations and determining whether I am better or worse than my competition in that market. If I'm worse, I'm going to find ways to improve that, find the ways to schedule more shifts, show up earlier in the morning, later in the afternoon, try to get trucks in and out faster, look for more drop and hook opportunities, so forth and so on.
Awesome. Next question from David. 2018 outlook looks good with the trade policy caveat. Do you have any market outlook or direction for 2019?
Well, I mean, I touched on it a little bit earlier. I think once you get to 2019, the big thing is that you're going to wrap a lot of the big tailwinds that the economy had in its favor. So, like, I mean, unless there's another tax cut in the works, which I don't think is feasible, like you're no longer going to get that kind of boost. And the economy right now is kind of operating a little bit on a sugar high, right? I mean, it was an economy that came into the year functioning pretty well. And then on top of that, it got like a bit of stimulus in the form of tax cuts for both businesses and households. And so as a result, you get 2018, which, like I said, looks like it's going to be a great year. 2019, I think you're going to see a much more normal kind of year. Like it's just going to, you're going to be like, you'll find yourself kind of gradually easing back down to this kind of long run growth potential of the U.S. economy, which isn't going to be like the around 3% growth that you might see in 2018. It'll be closer to like between 2 and 2.5% for next year. But yeah, I mean, I just think like once you get to the other end of all the different tailwinds that have helped the economy, you're just gonna settle. Hopefully, you gradually settle back down to what's kind of more normal.
Okay, great. We have a lot of great questions here. Appreciate everyone's engagement. We've got just a few minutes left, so probably 2 more questions we're going to pull from the bunch. Next one from Robert is conversion of company drivers to owner-operator with no forced dispatch is driving the spot market rates and rejection rates. Do you see the same trend?
Yeah, it's interesting. I think what's happening is drivers feel like, this happens every cycle. When the market's really good, credit is fairly loose. People are able to get finance for trucks. What's happening is the drivers that can go get trucks are actually buying trucks and becoming operators. And it's never been easier to be an independent operator than it is today. You have access to high quality freight on load boards. You have access to really nice credit terms. You have networks to join. There's a lot more transparency on pricing. It's much easier to operate as an owner-operator than it's ever been, and that's actually forcing a more difficult environment for the large asset carriers because drivers that are high qualified and can get credit end up becoming independent operators and running for whether it's a digital broker, a traditional 3PL, or are taking load and selecting off load boards. That's actually creating a tougher environment for the large enterprise carriers where whether it's fair or unfair, they view the idea of autonomy and independence to be highly attractive. And that's actually what's causing some of the types of drivers that would be ideal to work for a large carrier, just the psychology of that, the idea of freedom and being over the road, also is the same type of driver that really wants true independence. And when companies like Uber and Convoy and C.H. Robinson and Loads Through DAT are suggesting that the driver can do just as well, if not better, and be their own boss, it's a very difficult sell to convince somebody to be an over-the-road truck driver.
Okay, last question. I think it's a good one. Are you watching any particular canaries in the coal mine in the financial system that could create near or immediate term problems for the economy?
So as far as what I'm looking at right now, everything is just kind of hinging around how markets are interpreting tariff talk. I kind of mentioned earlier that a lot of what's been driving sort of the good underlying fundamentals is, I mean, the economy, people came into this year with an awful lot of optimism about where things were going with the economy. But I do worry about whether or not sort of like all this talk over tariff is going to cause some kind of significant decline in market prices, because there's all kinds of spillover effects that go along with that in terms of what it does to consumer confidence and consumer finances, and how that kind of plays out in the overall economy.
One comment I would make, Ibrahim, you turn on the news, you watch the markets, you start to panic if we're going to this big trade war. But when I talk to you, listen to you talk, you have this calming effect of don't panic. And so I think it's certainly refreshing to hear that there's no reason to panic, that we're not at the end of the cycle. There's nothing that suggests that. But to your point, is if the media continues to talk about things that are concerning, does that actually create its own issue?
Well, right. And I mean, when you look at like a lot of the talk, it involves numbers that sound pretty big. Like, you know, when they say like $100 billion worth of tariffs, like that sounds scary enough. But in the grand scheme of things, even $100 billion isn't that big for the U.S. economy. And it's much more about like where things might be headed than what's actually kind of come to pass, if that makes any sense. And so I'm just much more concerned that like people are going to begin to start fearing like a big kind of global trade war, and then it'll just kind of send shockwaves throughout everything. But other than that, I don't know. To me, most of the things, like I said, at least for 2018, look pretty good.
Good.
Yeah, and I think on the truck side, it's going to continue to be strong. So.
Good, good. I wish we had time to get to the rest of these questions, but we are at the top of the hour, so we're going to have to bring it to a close. Again, appreciate everyone for taking time out of your day to join us. We hope that you extracted as much value and enjoyment out of it as we do delivering it, and all the research and analysis that we put into it behind the scenes. Please look for our next monthly webinar notice to come out in the coming days for August, and we will be releasing a recording of this session as well as a link to the deck that was presented, so you'll have time to review it after the fact. Hope everybody enjoys the day, and we'll talk to you again soon.
Thank you.